Hey everyone, and welcome back to the Fish Market Academy, where we teach how to fish for gains. So in today's video, there's no camera because I sold it to buy the dip and right now I'm underwater. But let's explore, are we in a bear market? But just quick disclaimer, nothing I say is financial advice, and if you found this video useful, do remember to like and subscribe, and let's get started. So let's explore the macro updates first. So this week, after the FOMC meeting, it's probably likely that the Fed will increase interest rates during the March FOMC meeting in order to combat the high 7% inflation rate. If we take a look at December's labor market employment, the unemployment rate is at 3.9%, which is historically not too high. So the Federal Reserve did mention that they believe the labor market will remain strong despite increasing interest rates. And just to share for those who are not familiar, the Federal Reserve has two important missions. They call it the dual mandate, which is they need to have inflation at 2%, not higher than that, not lower than that, and they also need to have full employment. So full employment usually is around maybe 3% unemployment, so 3.9% is not too far from it, although there can be more people being employed. And right now they believe that despite increasing interest rates in March, they feel like the labor market will continue to remain strong. Unemployment will not go up, so they are very likely going to do this. And regarding the reduction of balance sheet, the Federal Reserve did say that they consider it, but it is probably not their preferred solution because they are not very familiar with what would happen if they were to reduce balance sheet compared to what happens when they increase interest rates. So most likely they're going to increase interest rates first and see how that goes, but it is not guaranteed that they won't do or will do. So because of this uncertainty, markets might also price in the fact that they may reduce balance sheet, which would be pretty bearish, but it's uncertain. So if the market starts to price that in, and during March probably during the March FOMC meeting, they are more dovish, which means they are not too bearish and not going to reduce the balance sheet, then the market might rebound a little bit from that meeting. But in the meantime, do expect that this uncertainty is going to cause more volatility and fear in the markets. There are also concerns right now between the ongoing conflict between Russia and Ukraine. Putin did say that he's going to do a ceasefire after an 8 hours talk at Paris, so that should quell any concerns for now, but the situation is still changing on a daily basis. My concern is that if Russia and Ukraine have any type of conflict, China might see that as an opportunity to show their military strength on Taiwan as well, but that is super speculative. I am in no way knowledgeable about this topic. It's just some potential repercussions that might happen. And we are probably going to see a flight to safety in the coming months as the easy money has ended and the margin debt in the economy right now is super high. I think we are close to 1 trillion in margin debt, and with rate hikes coming, the amount of margin debt might reduce drastically, which could send the market on a further tumble. So it's probably good to start reducing margin or leverage, paying back your debt, and of course lock in some of your gains to preserve capital. So just wanted to show some charts. If you look at inflation, the 7% inflation rate is the highest in almost 40 years. And this is pretty scary because back then when we had really high inflation, there was a gigantic spike in interest rate. So I don't think we'll see something similar because the USA really cannot have such a huge spike in interest rate. They can't repay their debt. But we probably will see interest rate going to probably 1% this year and potentially 2% next year. But next year is very speculative and hard to predict. In terms of the reasons why there was such a high inflation, the inflation report mentioned that it was primarily caused by used vehicles, which were up over 40%, food 6.3%, and shelter, which is like house or standard of living, basically 4.1%. In terms of the vehicles going up by 40%, I think largely speaking, people are looking to drive more because the pandemic is not as serious now in terms of like the lethality of COVID. Because like everyone is more vaccinated, and even if you get COVID, you probably won't get into anything too serious, assuming vaccinated, of course. And they are also looking to buy the cars today ahead of the interest rate hike, so that's why there is a spike in demand. But I think the demand should normalize eventually. I don't think it's going to up 40% every single quarter. That would be pretty insane. In terms of shipping, there's also labor shortage in supply chain / shipping companies, and that has caused inventory and shipping delays. And when there is inventory delays or inventory shortage and people are looking to still consume because the economy is like opening up or has more or less opened up, inventories are not able to meet the new demand, and that's why food is going up. At the same time, companies are stocking up inventory heavily to ensure they can meet the new demand from the economy opening up, and that's why there's a temporary increase in demand for a lot of inventory, causing the inflation. So Powell did mention in the FOMC Q&A that he feels that the inflation may be worse than in December in the coming months. So personally, I feel that inflation is pretty high already and it's not likely to keep going up, but definitely can still go up in the short term, and it should peak around Q2, by the end of Q2, as the economy normalizes and supply chains largely get back in order. But in terms of chip manufacturing, I think the supply chain shortage for that will probably persist for a while due to the shortage of semiconductors, and hopefully that improves in 2023 and onwards. So in terms of the skirmish between Russia and Ukraine that I mentioned earlier, it does seem pretty tense at the moment, but they just mentioned that Putin will have a ceasefire, so hopefully it doesn't escalate too bad from there. But if conflict does break out, then it might cause a chain reaction. Again, this is super speculative, and personally, I am not betting on any of these things happening, although it might be prudent to just have more cash in case we get a black swan event. Alright, now let's take a look at on-chain analytics and see what the fundamentals is happening for crypto. So in terms of the balance of Bitcoin on exchanges, we actually do see a record level low, which means people have actually been exiting from exchanges, and that's usually a bullish sign because you usually would deposit into exchanges to sell due to lesser slippage and lesser transaction costs. So the fact that during this entire downturn, people are actually still basically accumulating by not selling it, it's generally a bullish in terms of the fundamentals. This is unlike the previous bull run that we had in 2021 in the May period, where you could see that as the price of Bitcoin was topping out around here, people were actually depositing Bitcoin into the exchange to sell it. So this would actually be a sign that a crash is coming, but we actually don't really see that happening right now, where generally speaking, the Bitcoin exchanges is generally still in a downtrend. In terms of the balances held by smart money, so generally I would feel that people holding 1k to 10k Bitcoin are smart money, and you could see that as the amount of you could see that they were accumulating Bitcoin during this entire run-up. But once Bitcoin looks like it was topping out as the Coinbase IPO approached, you could see that they were aggressively selling off. And once Bitcoin started to capitulate, right, during the May crash, they were starting to accumulate. And it has went generally sideways during the past few months. But in the most recent month, which means like January, you could see an uptick in the terms of the amount of Bitcoin that they are accumulating. So you could sort of say that smart money is accumulating, but we're not seeing a very clear-cut evidence until this goes back above previous high. So then that would be a very clear illustration that smart money is kind of accumulating. But in terms of the long and short-term holders in profit or loss, this is a pretty good short-term indicator on when a temporary short-term bottom is. Basically, the red one, the deep red ones, are the short-term holders in profit. And right now, we are basically at 0% short-term holders profit. This is usually a sign where it's basically bottom. If we look at the March crash of 2020, you could see that when the deep red portion reached 0%, it's basically the temporary bottom. And then in May last year, when it reached near 0%, it was also the temporary bottom. So right now, we are also basically facing the same scenario where we are at 0% short-term holder profit. And I would say we are probably in a temporary bottom as well. So I don't think Bitcoin is going to drop below 33k anytime too soon, unless there's a black swan like a war happening. And in terms of funding rate, we are actually in the negative. So if you look at funding across the board, it's all negative. So you're actually being paid to short. So it's usually a sign that a short squeeze could happen. And I think if you are looking to short, it might be more prudent to go heavily on shorts after funding rates are not so negative, because you're going to be spending a lot of money for the funding and you might be getting short squeeze if whales or market makers decide to squeeze the shorts. But if we do get a short squeeze, I think Bitcoin could go to 40k at least, potentially 40 to 44k, but I wouldn't be very bullish on it. I'll probably use that as an opportunity to offload my positions or to actually start to short from that level, because I think it's probably too early, too premature for a new fresh bull run, and I would see it as a dead cat bounce. So generally, in terms of the market outlook, for the main blue chips like Bitcoin and Ethereum, I think at the very most, right, they shouldn't drop more than another 30 to 40% over the next few months. assuming there's no war. So I feel like the bottom for Bitcoin is 20k. The bottom of ETH should be around 1.4k at the worst case scenario. Of course, I could be wrong, but I really think those levels would be a great entry if we zoom out in the grand scheme of things, assuming that the Fed continues to have inflation at 2% yearly and we don't go into deflation. Another thing to take note is that there is midterm elections in November, so I'm pretty sure the market will start to pick up around Q3 before the midterm elections, so that the elections will do better for Democrats during this period. And if you are sitting on a lot of cash and you are more long-term, I definitely recommend starting a DCA this period. We are in historically really decent valuation zones, so DCAing is definitely an okay move if you are long-term and you are able to withstand volatility and you don't need the money in the next few months or even years. So in conclusion, the Federal Reserve will raise rates probably due to inflation, and I think we are in a short-term bear market, and this bearish sentiment will stay until CPI goes down, which I believe will probably peak around Q2. Like, I think in Q2 onwards, CPI will start to go down, and I feel like this bearish sentiment will start to disappear. And then especially into Q3, we have the midterm elections, it will start to go up. But in the meantime, I feel like the market will continue to bleed for a few months with a lot of volatility and unsustained rallies. But we might get an immediate short-term bounce as soon as next week, because I feel like we have temporary bottom in terms of sentiments, in terms of token prices. A lot of them are really oversold. But again, I feel like this would be dead cat bounces, so not something that you want to chase the rally. Although there will still be certain sectors that can rally very strong into new highs, like NFTs and metaverses seems to still be doing decently in terms of the narrative. So that's something to not fade completely if you want to have some exposure in the space. So personally, I've locked in some profits and I'm sitting on about 30% cash, and I might even go for to 50% cash if we get a good bounce. At the end of the day, I think no one has ever gotten broke taking profit, so that's something that you should consider in terms of capital preservation. And yeah, that's about it for this week's video. So if you found this video useful, do remember to like and subscribe, and I'll see you guys again soon. Bye!
Baby fish do 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 do, baby fish do 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 do, baby fish do 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 do.